I just noticed behind me John Deere tractors. I know a lot about John Deere. I love the company. But as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico.
President Trump's trade war is affecting America's ports. Container shipment bookings are down nearly 50% from a year ago.
Across the United States, over 3,000 tractors have reportedly been taken offline in what many are calling the most widespread farm production halt in recent memory. At the same time, equipment prices have surged by more than 12% in less than a year, driven by tariffs, inflation, and growing dependence on proprietary technology. Meanwhile, analysts project John Deere's stock could rise another 20% in 2025, thanks to strong Q2 earnings and increased investment in high-tech agriculture. So the question becomes, who's winning and who's being left behind? This isn't just a protest, it's a warning from the people who feed the country, those who feel they're being priced out, automated over, and forgotten. The growing disconnect between American farmers and the system they depend on is no longer subtle, it's structural. Over the past decade, farming has evolved into a highly digitized industry where success increasingly hinges on access to proprietary hardware, embedded software, and platform-based technologies. Leading companies like John Deere have pioneered innovations in precision agriculture, investing billions into AI automation and cloud-connected machinery designed to optimize every aspect of farm operations from soil analysis to autonomous planting and harvesting. But for many small and mid-sized farmers, this rapid shift doesn't feel like progress. It feels like exclusion. While these tools offer impressive potential, they come with steep upfront costs, ongoing subscription fees, and restrictive licensing agreements that prevent farmers from repairing or modifying the equipment they technically own. Instead of empowering independent producers, the system increasingly locks them into closed ecosystems where access, functionality, and even service depend on corporate control. Meanwhile, the economic fundamentals of farming haven't improved. Input costs are rising. Crop prices remain volatile and profit margins continue to shrink. For many rural communities, the equation no longer adds up. Technology is advancing, but the benefits aren't trickling down. In fact, in many places, the technology is pricing people out. The pressure is especially intense in states like Iowa, Nebraska, and Kansas, where family-run farms are disappearing at an accelerating rate, often replaced by larger tech-enabled agribusiness operations with deep financial backing. This isn't about resistance to innovation. Most farmers embrace tools that help them work smarter. The issue is equity. Who gets access, who gets left out, and who holds the power when farming becomes a data-driven industry managed by algorithms and cloud platforms. And in 2025, that power increasingly lies not in the hands of those working the land, but in boardrooms and software servers far removed from it. From the cornfields of Iowa to the almond groves of California, something unusual is happening. The machines have gone quiet. In recent weeks, observers across agricultural states have reported a growing number of tractors, harvesters, and sprayers sitting idle, not because of mechanical failure, but because of choice. Farmers unable or unwilling to continue under current economic pressures are shutting down their own operations, not with signs or rallies, but with silence. Some in the media have called it a spontaneous shutdown, but for those closest to it, the story runs deeper. This isn't a strike. There are no press conferences, no unions marching in protest. There's just a kind of quiet defiance, machines, parked fields left unworked, and voices unwilling to shout because they've long been ignored. What we're seeing isn't organization, it's exhaustion. For many, this pause in production is not a tactic, it's a last resort. After years of navigating rising input costs, limited repair access, volatile commodity markets, and a growing dependence on equipment that's increasingly unaffordable or unserviceable, these farmers are reaching their limits. And while some may interpret this as economic hesitancy, those on the ground understand it better. This is what rebellion looks like when the people rebelling are too tired to fight. In rural America, where pride often prevents public protest, a silent field can say more than a shouting crowd. It signals a deep erosion of trust in the system, in suppliers, and in the belief that the future still includes small independent producers. No slogans are needed when the land itself is speaking. And right now, the land is saying we've had enough. As fields across the country fall silent, there's one corner of the agricultural world that remains remarkably upbeat: Wall Street. In May 2025, John Deere posted stronger than expected Q2 earnings, beating revenue forecasts and reinforcing its reputation as a resilient, forward-looking industry leader. According to MarketBeat, the company's performance was driven not by traditional gains in manufacturing volume or domestic sales, but by its strategic pivot toward high-margin technologies, particularly AI-enabled equipment, precision ag platforms, and subscription-based software tools. These innovations, many of them targeted at large-scale operations and global markets, have redefined Deere's identity in the eyes of investors. Analysts responded by upgrading their forecasts, with some projecting a 20% rise in share price over the coming quarters. For shareholders, the message was clear and welcome. Deere's future doesn't depend on building more tractors in the Midwest. It lies in digital ecosystems, automation, and recurring revenue streams. The financial markets rewarded the shift. Shareholders were cheered. Executives were praised. Broker reports flashed green. The earnings call was filled with language about agility, transformation, and long-term shareholder value. But while Wall Street applauded, the view on the ground was far more subdued. In places like Iowa, Nebraska, and Georgia, where Deere's logo still marks shuttered factories and struggling dealerships, there were no celebrations. Farmers, many of whom rely on these machines not as optional investments but as essential tools for survival, saw little reason to cheer. Their operations remained stalled, their margins squeezed, and their trust shaken. The disconnect couldn't be clearer while Deere grows more profitable and tech-forward. The people who once built its reputation are being quietly left behind. This moment captures a deeper truth about the direction of modern agriculture. One side sees progress, the other feels forgotten. Deere's transformation may be brilliant from a business perspective, but it's also a signal that the system as it stands is delivering returns not to those growing the food, but to those trading the stock. And for now, the rewards are flowing in only one direction. The quiet shutdown now rippling across America's farmlands may seem localized, a rural issue, a seasonal delay, but the implications stretch far beyond the fields. If thousands of tractors remain idle and planting seasons slip by, the result is inevitable: domestic food production will fall. And when that happens, grocery prices rise not months from now, but within the same year. In an economy already strained by inflation and uneven recovery, the warning signs are flashing not just for farmers, but for families in every zip code. This isn't speculation, it's systems theory. When production halts at the source, pressure builds downstream. Warehouses wait longer, distributors absorb volatility, retailers pass it on, and consumers, already facing high costs for essentials, pay more at checkout. In this way, a silent protest in Iowa becomes a grocery bill in New Jersey. The food supply chain, like any other infrastructure, is only as strong as its most stressed segment, and right now that segment is the small to mid-sized American farm. But supply and price are just the beginning. There's a deeper, slower erosion happening, one that may prove harder to reverse: the loss of public trust in the agricultural system itself. For generations, the USDA food system has depended on the idea that even if the markets shift, and even if weather or politics disrupt short-term flows, the foundation remains stable. The farmer is still planting, still harvesting, still feeding the nation. Today, that confidence is wavering. If farmers walk away, not because they want to, but because they can't afford not to, what does that say about the priorities of the system? If innovation comes without inclusion and productivity rises while participation shrinks, the long-term viability of domestic agriculture becomes not just an economic issue, but a societal one. And in that vacuum of trust, anxiety grows. Will we import more of our food from overseas? Will mega-farms replace the diverse backbone of family agriculture? Will a handful of platforms and corporations control not just how food is grown, but whether it's grown at all? These aren't distant hypotheticals. They are real emerging risks in 2025. And they all begin with what looks at first like nothing: a tractor that doesn't move and a farmer who won't start the engine. At the heart of this quiet upheaval is a larger, more difficult question. Is the future of farming being built for everyone, or just for those who can afford to keep up? As John Deere and other agricultural giants push forward with smart farming innovations, satellite-connected tractors, AI-optimized planting systems, cloud-based diagnostics, a new kind of divide is emerging, one not based on land or labor, but on access to data, bandwidth, and capital. What happens to the farmer who can't afford a $500,000 or autonomous tractor? What happens to the rural county where internet speeds are too slow to run cloud-connected machinery? Do these farmers have a place in the system of tomorrow, or are they being quietly phased out, not through policy, but through design? These aren't rhetorical concerns. They speak to a very real transformation in the identity of American agriculture. Once a symbol of rural strength and working-class dignity, Deere is now praised for its quarterly earnings, its platform strategy, and its future-facing investments, all signs of a global tech company more beholden to shareholders than soil. So we have to ask, is this evolution or erasure progress or abandonment? When innovation serves only the largest and most well-resourced operators, and when the companies that once represented American farmers now speak the language of venture capital and data analytics, who gets left out and who gets to decide what counts as progress? This isn't just about one brand, one industry, or one quarter's performance. It's about whether we believe technology should lift up entire communities or replace them. So now we turn the question over to you. Is this a breakthrough or a breakdown? Is the rise of smart agriculture a genuine revolution in food production, or is it slowly pulling the plug on the farmers and communities that once fed the nation? This isn't just about technology. It's about fairness. It's about who gets to shape the future and who gets left behind in it. Let us know what you think in the comments. Because whether you live in a city apartment or on a rural road, the future of your dinner table starts with the fields and the people growing the food today.